Hello everyone, welcome back to the channel, and thank you so much for being here, because today's update on the UK housing market is absolutely critical for anyone who owns property, is thinking about buying, or is simply trying to understand where this economy is heading next. On the surface, the headlines are full of excitement, talking about house prices surging again and the so-called property revival. But once you dig beneath that glossy layer, the story becomes far more unsettling. And the risks hiding underneath could end up reshaping the entire UK property market in ways most people are not prepared for. Right now, mortgage rates are falling at a pace that very few experts predicted just months ago. The average 2-year fixed mortgage rate has dropped below 4% for the first time since early 2023, and 5-year fixes are even lower, hovering around 3.7%. Some lenders are now offering eye-catching deals as low as 3.5%. For buyers with large deposits, a dramatic reversal from the chaos of 2022, when Liz Truss's mini-budget triggered a market meltdown and mortgage rates surged beyond 6% almost overnight. That period caused panic, froze transactions, and wiped out confidence. Now, banks are locked in a full-blown price war, competing aggressively for borrowers, and for millions of people who were completely priced out last year, borrowing suddenly looks affordable again. This sudden drop in rates has reignited buyer demand almost instantly. Rightmove has reported a 20% jump in buyer inquiries compared to the same time last year, and estate agents across the country are seeing viewing numbers climb sharply. In desirable areas, properties are attracting multiple offers within days of hitting the market, and in some cases, sealed bids are making a comeback, something that hasn't been seen consistently since the pandemic boom. First-time buyers who had all but given up are now running the numbers again and realizing that, at least on paper, home ownership might be back within reach. Momentum is building fast, and major forecasters like Savills and Knight Frank are already revising their outlooks, with some now predicting house prices could rise by as much as 4% this year alone. If you want to stay ahead of every twist and turn in the UK property market, make sure you hit that subscribe button right now and smash the like button, because this channel brings you the real story behind the headlines, covering the economy, housing, and property news before it hits the mainstream narrative. But here's where the story takes a darker turn, because this apparent boom is not being driven by strong economic growth, rising wages, or a sudden surge in population. Instead, it's being fueled almost entirely by one assumption, that the Bank of England will continue cutting interest rates throughout 2025. Financial markets are currently pricing in at least 3 more rate cuts this year, which would push the base rate down to around 3.25% by December. Buyers, lenders, developers, and analysts are all treating these cuts as if they are guaranteed, baking them into forecasts and acting as though cheaper borrowing is already locked in. The problem is that the Bank of England itself is sounding far less confident than the markets. Inflation, which was expected to keep falling smoothly, has proved stubborn. In recent months, it has edged back up instead of continuing its decline. Core inflation, which strips out volatile items like food and energy, is still sitting around 3.2%, well above the bank's 2% target. Wage growth remains elevated at roughly 5%, and that is feeding directly into service sector inflation, which has been incredibly difficult to bring under control. Several members of the Monetary Policy Committee have publicly warned that cutting rates too quickly could reignite inflation and undo the painful progress made over the last 2 years. While markets are expecting a dovish stance, the bank is clearly becoming more cautious. At the same time, government policy is making the bank's job even harder. Rachel Reeves's recent budget included major spending commitments, higher public sector wages, and large-scale infrastructure investment. While this could support long-term growth, in the short term, it adds stimulus to an economy that is already hotter than expected. Employer national insurance contributions are rising, and many businesses have already said these costs will be passed on to consumers through higher prices. The Office for Budget Responsibility has warned that these measures could add around 0.5 percentage point to inflation over the next couple of years. This puts the Bank of England in a bind. If the government is stimulating the economy through spending, the bank has less room to stimulate through rate cuts without risking a return to runaway inflation. Fiscal and monetary policy are pulling in opposite directions, and something will eventually have to give. Globally, the picture is becoming even more complicated. Donald Trump is back in the White House and has already announced sweeping tariffs on imports from China and the European Union. These tariffs are likely to push up global costs, and the UK will not be immune. If inflation starts rising internationally, central banks everywhere will be forced to think twice about cutting rates. The US Federal Reserve has already signaled that it is in no rush to ease policy further, and the European Central Bank is also sounding more cautious. If the Bank of England cuts rates aggressively while others hold steady, the pound could weaken sharply, making imports more expensive and adding to domestic inflation. It's a delicate balancing act, and the external pressures are only growing. So what happens if the Bank of England doesn't deliver the rate cuts everyone is expecting? Or worse, if it has to pause or even reverse course? The impact on the housing market would be swift and brutal. Mortgage rates would jump, potentially even higher than in 2022. As markets panic over the inflation outlook, buyers who stretched themselves based on today's rates would suddenly find those mortgages unaffordable, leading many to pull out of purchases altogether. Demand would evaporate almost overnight. Prices would stall or fall, and sellers would be forced to slash asking prices to attract buyers who can no longer borrow as much. Anyone who bought at the peak expecting further gains could find themselves in negative equity very quickly. This is not theoretical. We've seen this exact pattern before. In 2022, the market was flying on ultra-cheap pandemic-era mortgages, and when rates spiked, transactions collapsed by nearly 30% year-on-year. Prices fell for consecutive months, wiping out recent gains, and thousands of deals fell through. The difference now is that prices are even higher relative to incomes, meaning the market is more sensitive than ever to changes in borrowing costs. In many areas, the average house price is close to 9 times the average salary, so even small rate movements have outsized effects on affordability. Estate agents are already noticing warning signs. Sellers are pricing homes as if rate cuts are guaranteed, while buyers are starting to hesitate, sensing that the numbers don't quite add up. The gap between asking prices and achieved sale prices is widening, and properties are sitting on the market longer than expected, despite the apparent surge in interest. Some buyers are pulling back after realizing that if rates don't fall as hoped, they could be locked into unaffordable monthly payments for years. Others are waiting on the sidelines, betting that disappointment from the Bank of England could bring prices down. Supply-side risks are also being overlooked. House builders have increased construction based on expectations of strong demand, but if that demand disappears, they could be left with unsold stock and mounting debt. Several major developers have already warned that rising costs and planning delays are squeezing margins. If sales slow, a wave of distressed selling from builders could flood the market with new supply just as demand weakens, putting further downward pressure on prices. This is exactly what happened during the 2008 financial crisis, when several builders came close to collapse. Buy-to-let landlords are under pressure too. Higher stamp duty on additional properties, increased capital gains tax, stricter energy efficiency rules, and reduced mortgage interest relief have all eroded profitability. Many landlords are finding that rental income no longer covers their costs, especially if mortgage rates rise again. A growing number are choosing to sell up, adding yet more supply to an already fragile market. At the same time, renters are suffering as rents continue to rise sharply due to reduced rental supply, creating a vicious cycle where neither buyers nor renters truly benefit. First-time buyers are perhaps the most exposed of all. Many are being encouraged to buy now before prices rise further, but they are also at risk of being trapped if the outlook shifts. Borrowing at the maximum leaves no buffer for job losses, income shocks, or rate rises. If inflation stays high and rates fail to fall, the message right now is simple but crucial. Whether you are buying, selling, investing, or renting, proceed with extreme caution. Do not assume rates will keep falling or that prices will keep rising. Build buffers, avoid stretching to the limit, and stay realistic about valuations. The UK property market has always been volatile, but right now it feels especially fragile. The next few months could determine whether this turns into a genuine recovery or the start of another painful downturn. Make sure you stay informed, because what happens next could change everything.